My name's Brett Savill. I'm going to provide a few tips on basic fundraising. I'm going to do this around three main themes. Firstly, I think it's important if you're negotiating with people whose job it is to buy and sell businesses that you understand how to value a business. So I'm going to do something about Value 101. Secondly, I'm going to talk a little bit about the funding ecosystem and the fundraising process. And then thirdly, I'll just finish up with some tips on next steps. Firstly, what is fair market value? You may have heard of this. Fair market value is an estimate of the value of a property or a company based on what a knowledgeable and willing and unpressured buyer would pay to a knowledgeable, willing and unpressured seller in an open market. So fair market value is really what you need to think about, and fair market value means that both sides have to agree and not be pressured, and also understand what it is that they're getting themselves into. It's measured in two ways. There is equity value and there is enterprise value. So very often you will have heard that a business might be valued at 10 times its profits or 10 times its sales. That's its enterprise value. But what that means if it's acquired is that you might get less or more than that for the equity in the business, depending on whether it has debt or cash. So there is equity that has value, and you add or subtract the debt or cash to get to the enterprise value. So what are the main methods of valuing a business? Well, there are only three, you'll be pleased to hear, and each one has different pros and cons. There is the cost method, there's comparable multiples, and then there's cash flow. So the cost method is very often used for a new product that may not have revenue. What did it actually cost to build this piece of software or this building? And there are many advantages to using the cost method, because whilst people may claim that they will have future sales or future opportunities or an enormous revenue stream coming up, it's very hard to prove that. The advantage of cost method is that it provides a very clear counter to other valuation methods, and it provides you with a baseline. So clearly, if it costs $1 million to build a piece of software that does something, if somebody wanted to sell it to you for 10 million, you'd really have to know what the other 9 million was going to. The second method is comparable multiples. So comparable multiples may be revenue or profit multiples, and you can get those from similar acquisitions or from listed companies, but it also could be non-financial methods. So very often media companies would be valued per subscriber, for example. So that's comparable, and that's a good relative valuation tool. And then the third one is the discounted cash flow, which is a method for evaluating the unique opportunity or intrinsic value of a startup. The advantage of cash flow is that clearly it represents the unique circumstances of the company. The disadvantage from the perspective of a buyer is that it involves an estimation of what might happen in the future, which is uncertain. So therefore, the advice to companies and to people both buying and selling is use cost, comparable and cash flow, all three, and triangulate to get to some sort of valuation that you agree on. So now we're going to move to the fundraising ecosystem. And there are many different types of funding. You could start with getting revenue from customers, which is obviously the easiest and most efficient. You can put in your own equity, you might get a government subsidy, you might have debt, or there's something called sweat equity, which is where you put your time and effort into starting up a business for no return. And these different types of funding mechanisms occur across the spectrum of investors. So if you're looking to raise a small amount, very often you would go to friends or family or founders. If you're looking to raise a larger amount, you may go to an angel investor network, and there's one in every major city across Australia. Crowdfunding gets a bit of publicity, it's still quite small. And then as you get bigger and you want to raise in the hundreds of thousands or millions, you'd go to venture capital. And then if you want to raise tens of billions, you'd probably go to the stock exchange or private equity. The market has gone through a lot of turmoil. So basically up until 2020, we had seen steady growth in the amount of money that was raised for venture capital and the amount of money that was deployed. But as you can see from this graph, in 2022 we saw a significant dip in terms of fundraising, and we also saw a dip in terms of deployment of capital for startups. So there's less money around, there's less money being raised, and valuations have reduced as well. So let's just finish up briefly on what to do to raise capital. So one of the things that you will need to do is develop a pitch. That needs to be very clear, and it is usually organized around 4 principles. What is the problem that your idea or business solves? What's the solution? Why is it unique? What team have you got? And what's the traction? So once you've developed a pitch deck, you then need a hit list, and this is a broad list of potential investors. It could be angel investors, it could be VCs, it could be corporates or suppliers. My advice would be to keep that list as broad as possible in the initial stages. You then develop a newsletter, and I found that updating people on a quarterly basis is certainly very helpful. You'll need a cap table, so basically this just indicates how much of the equity you've got, how much that you expect to raise, and what the dilution would be. And finally, you need time. Now, in my experience in the market today, it can take up to 18 months for companies to raise capital from the first meeting with an investor. What that means is that it's absolutely critical for companies to take the time to get to know investors and start your capital raising journey well before you need the money. So what will happen when you send out your pitch deck or your first newsletter? Well, it'll be picked up, if you're lucky, by a junior analyst. If the junior analyst likes it, he may contact the senior partner. The senior partner may agree to come back with some questions. You may finally end up with a meeting. This is a long and complex process that will take time. Therefore, it's really important for somebody looking to raise money that they carve out time during their week to be able to do this. So 2 things to take from this. The first one is give yourself time to get to know the investors before you raise the money. It could take you up to 18 months. And secondly, every week you've got to dedicate time to getting to know investors and potential investors. I guess one of the observations that I have about startups is that they spend a huge amount of time on the market for their goods and services, proving the concept, selling to customers. And what they need to do is extract themselves from that and spend time thinking about the market for capital as being like their customers for their day-to-day products. Give yourself the time, have a thought-through process, and get to know these people well before you need the money. If you're lucky, you'll get through to due diligence, and at this point it's worthwhile having some documents in place. If you don't already have these, a business plan should focus on your competitive positioning, risk management, the business model, and so forth. Funding documentation will be required. We've talked about the cap table, but you'll also need some form of capital raising documentation. Sophisticated investors will probably bring their own safes, but you might want to have one, and there's plenty available for free off the internet. And finally, you'll need the standard due diligence documents that any investor will want to look at. Accounts, if you've got them audited, supplier and distributor agreements, any IP, your IT and your employers and their contracts. I'll just finish up then on the role of advisors. In the journey that you will go through to raise capital, it's very common to use advisors, and the advisors could be accountants, lawyers, consultants, M&A advisors, the government, an advisory board. If you're thinking of bringing on an advisor, it's worthwhile considering how you remunerate them. If you pay them on a set fee, the danger is that if it's a time and materials contract, that they will drag it out. If you give them a success fee, the danger is that they will push you through to a deal that may not always be in your best interests. So think carefully about the remuneration, because that's how the advisor will behave. Secondly, as is choosing your top team, as with choosing your close friends, what you want is somebody that you can trust, somebody that's competent, motivated, and provides value for money. So you're perfectly entitled to do due diligence on your advisors. And one of the things that I always advise the companies that I deal with to do is to ask any potential advisor to give them a list of people that they've worked with that you can contact to find out what the feedback is like. If you get this right, there are significant benefits of using an advisor. There is a competence in an area that you may not have. They may well have contacts that you don't have. They should be able to accelerate the timing, and it's a strong signal to the people that you're negotiating on the other side that you're serious. We've talked a little bit about Valuation 101. We've talked about the fundraising ecosystem and the fundraising process. It's now time to begin your capital raising strategy. So what I'd say is, whether you're a beginner, an intermediate, or an expert, make sure your pitch is up to scratch, develop a hit list of people that you're going to deal with, develop a newsletter, consider advisors, look at the documentation, think hard about your financial and personal objectives from this capital raise, and give yourself the time. On the final slide, I've put 3 bullet points that are all blank, and I'd like you to have a think about what you're going to do next. Many thanks indeed, and good luck with your capital raising journey. This is Brett Savill for First Nations X.